myself Aditya P. Tripathi, we are once again here to continue our discussion on the topic of analysis of financial statements. This is going to be the first part of our lectures on analysis of financial statements. And here, to be very precise, I shall be focusing on the two different types of analysis about which most of the times my students are asking that, sir, we are not able to understand how to conduct horizontal analysis and how to conduct vertical analysis. So I shall first be telling you about the methods for meaningful analysis of financial statements, what are the different methods into that. Then we shall talk about horizontal analysis, that what are the different techniques into horizontal analysis, and in the second part we shall talk about the vertical analysis. So with this agenda I am going to tell you about the financial statement analysis, what exactly is the purpose behind it. The very pertinent question which comes to us is, why do we conduct this kind of analysis? What is the point of conducting analysis of financial statement? Because already we have income statement with us, we have balance sheet with us, and now we are planning to start with the analysis of it. So who is the user, and why are we going to conduct this kind of analysis? So the very basic reason for that is we actually wish to have a meaningful analysis. We wish to know the performance and financial health of an enterprise in a dissected manner. So a kind of dissection process we are following here, and we are trying to add some meanings to the data. Or in other words, we can say that we are trying to give voice to the data. The data starts speaking when we conduct this kind of analysis. Data speaks in front of us that we are conducting a meaningful analysis, and suppose we are provided with the figure of profitability or say solvency. It is simply a value which is given in the income statement or in the balance sheet. But when we conduct the analysis, we actually get the meaningful insight out of the data, that what exactly this gross profit means, what exactly this net profit means, what is the meaning of this expenditure ratio, operating expenses ratio. So this kind of dissection we are trying to do, and for that we need to analyze. And the basic purpose is that whatever the information which is conveyed, it can also be used for making estimates about the future. Because at the end of the day, as a management accountant, we have to do some planning, we have to take some decision making, and for that this whatever information we are getting from the financial statement, that need to be analyzed, and for that we are conducting this kind of analysis. But when we conduct this kind of financial statement analysis or analysis of financial statements, we have to always keep in mind certain important aspects of the analysis, to which we call as basic caveats. That what are the alarms to you, what are the indications to you, what are the I won't say threat, I would say that it is the caveat to you that you have to keep in mind. So the first caveat is that what is your purpose? What exactly is your objective in conducting this kind of analysis? So the first and the foremost focus of analysis will depend upon the purpose for which you are conducting this kind of analysis. So your purpose is going to decide your method, and accordingly you will actually be conducting your analysis. So the first caveat is that my focus of analysis shall be determined by the purpose for which I am conducting this analysis. The second important aspect is the depth of analysis. To what extent I am going to conduct this analysis, whether I am going to be deep down, going to conduct a deep analysis of that data, or I am just going to draw some inference by simply having a look at the data. So it is the depth of analysis which is again an important factor, and that depth of analysis will always depend upon the availability of data. Unless you have the data available, unless you have requisite amount of water, requisite length of deepness, how can you conduct in-depth analysis? So the depth of analysis will actually depend upon the availability of data, that to what extent you have access to the data. If you have complete data available, if you are basically an internal user, say a management accountant, of course you have the entire access to the entire data set. Whereas if you are an external party, say a banker, or you have given money to you have lended money to this organization, in that case definitely you cannot conduct in-depth analysis. You have to rely on the secondary data which is available in front of you. And thirdly, analyzing the financial statements of an entity for a specific period may not be sufficient, because unless you have the series of data, you cannot conduct a requisite analysis. So the changes occurred in the financial statements over a period of time are always supposed to be more useful than concentrating to the data of one particular year only. So when you are conducting this kind of analysis, the length of data, the series of data which is available to you, that is also going to determine the quality of your analysis. And when we talk about the classification, it can be inter-period comparison or it can be inter-firm comparison. Having said inter-period comparison, I wish to indicate that my analysis shall be focusing on timings. So when I am comparing the balance sheet or say profit and loss account numbers over a period of time, when I am conducting this analysis, we call it inter-period comparison. For instance, I have profit and loss account and balance sheet of 2021 and 22. And for these 2 years, when I am making a comparison that what was my gross profit in 2021 and what is the amount of profit in 2022, that is going to be called as inter-period comparison. So you are basically comparing the data of two periods. That is why we call it inter-period comparison. Whereas when you are trying to compare the performance of two different entities or enterprises, we call them inter-firm comparison. And having said inter-firm comparison, I wish to basically put a stress on this, that we are going to compare the balance sheet and profit and loss account numbers of one enterprise with that of another one. But when we conduct this kind of analysis, we have to always keep this thing in mind, that these industries, these firms must be related. Suppose if I am talking about a pharmaceutical, a company operating in pharmaceutical industry, the comparison cannot be done with other industry. I cannot compare the performance of a pharmaceutical company with that of automobile company. So in inter-firm comparison, we have to keep this thing in mind. We have to rest assured that this analysis is going to be conducted between the two related companies. Otherwise there shall not be any level playing field. So inter-firm comparison or inter-period comparison, these are basically the two broad parameters when we conduct, or basis when we conduct financial statement analysis. So while analyzing financial statement, either it shall be inter-period comparison or it shall be inter-firm comparison. So no matter which method we are going to follow, we have to keep this thing in mind, that either we shall be focusing on two different periods or more than that. Suppose there is a time series, you are taking the data set of say 5 years, 6 years, 10 years, then obviously the data set, you can call it a time series analysis, but again it is going to be a comparison of inter-period, that is based on time. Whereas when we are conducting inter-firm, then of course it is going to change, because you are comparing the data of two different firms. And financial statement analysis as a management tool is in a way very flexible. We don't have that kind of I won't say rigidity, but I would use an appropriate word called stringent norms when we are doing financial accounting. When we are following the rules and regulations of financial accounting, we are in a way we cannot compromise with the norms, with the standards. Suppose I am preparing a financial statement, I cannot compromise with the guidelines laid down in IFRS or Ind AS as far as India is concerned. Whereas in case of financial statement analysis, I have that freedom. I have that freedom or flexibility which somehow we are not able to enjoy in case of preparation of financial statements. Because those financial statements, they may be prepared using prescribed formats and principles which may be stringent. And there are no such formats or rules as far as financial statement analysis is concerned. So this is the point where we are a bit relaxed, that see, we don't have to abide by those prescribed formats, we don't have schedule 3 format, we don't have those sections, subsections, we don't have to bother about those standards, substandards, guidelines. Here we are focusing on the analysis. And the fundamental rule in this entire process of analyzing financial statement is that anything which can help in better understanding of financials, whatever is provided in financial statement, is going to be acceptable. Because my ultimate goal is not to prepare any income statement or balance sheet. My ultimate goal is that anything which can help me in better understanding of the financial data. So any activity, any step, any method, any tool, any advice which can help me, which can help me in understanding the meaning of that data, and which can guide me in taking the further decisions, that is always welcome, that is always acceptable. And that is the beauty of management accounting, that when we are conducting this kind of analysis, we don't have any prescribed format, we don't have any specific format to be adhered to. We have to simply focus on adding voice to the data, that my data should speak, that see, this is the ground reality, and if you don't take care of this problem as of now, in future this may result into huge losses, or this may result into loss of opportunity, and whatever the case is. So with this fundamental rule in our mind, we are going to now understand what are the different types of financial statement analysis, what are the different types of analysis that we are going to conduct. So we have some internal analysis, we have external analysis based on the users. If we classify based on the timing, it can be short term, long term. When we classify on the basis of the very nature of analysis, it can be static, dynamic, or what we call as horizontal and vertical. So broadly speaking, this analysis of financial statements, when we talk about different techniques, these techniques may be categorized on the basis of different parameters. It can be based on the users. If it is done by the internal user, then of course it is going to be a kind of internal analysis. Whereas when it is done by external people, external parties, third parties, it is going to be called as external analysis. When the timing is for short run, say within one operating cycle, we call it short term analysis. But when you cross that period of 1 year, or what you call as one operating cycle, it is going to be a long term analysis. Here in this discussion, I shall be telling you, with a great focus or emphasis on horizontal analysis, or what you call as dynamic analysis. I shall tell you why do we call it dynamic, because it is basically a horizontal analysis, but why do we call it dynamic, and why vertical is static. So in due course of my discussion, I shall be telling you why do we call it to be a dynamic analysis. So when we are preparing statements in comparative and common size form, basically we understand that it can be rupee and percentage change on statements, it can be a common size statement, it can be a ratio analysis. But in this entire process, my goal is that an item in a financial statement has little meaning by itself. Whatever data is given, it is not going to provide you the description. The understanding of the numbers may be enhanced by drawing comparisons. So when we start comparing the data of one period with that of another, one company with that of another, then of course the understanding of the numbers is going to improve drastically and dramatically. At times we fail to understand. We look at sales, cost of goods sold, gross profit, expenses, net profit. We feel it's a routine process. But when we compare the gross profit of current year with that of previous year, then of course the data starts giving some indication to me. It is just like you sitting in the class, devoting 3-4 hours into your studies and feeling that I have completed my entire task. I am now through with this entire chapter. But you realize your mistakes when your friend tells you that, see, you have conducted these kind of analysis, you have covered these topics, but this topic has been left by you inadvertently. So it is just like that. When you are working on some topic in isolation, then of course you are not able to realize that what exactly is there in outside that contours of my thinking. So your broad contours may be different, your friends broad contours may be different. So this is why we conduct this kind of analysis, what you call as horizontal analysis. Now, what is horizontal analysis? If I have to define, I would say that comparative financial statements and trend percentage analysis, they are most commonly used techniques. Whenever I ask my learners, my students, that what is horizontal analysis, nobody explains it to me. Everybody says, sir, in this horizontal analysis we are preparing comparative financial statements, and we are preparing trend percentage analysis. So they basically tell us about the technique, not exactly the meaning of this horizontal or dynamic analysis. As the term itself indicates that you are moving parallel to x-axis. So as a student of economics, you basically think of going parallel to x-axis, which means horizontal. Vertical means when you are on y-axis. So when we talk about horizontal analysis, it means I have to move from either left to right or right to left. So it happens only when we are conducting an analysis for the data of two periods or two companies. So of course when I have data of 2-3 years or 2-3 companies, then it is going to be called as horizontal analysis. And this analysis basically indicates the changes between the years in financial data in two aspects, in two terms. One in terms of absolute, that is in terms of rupee as far as India is concerned, and another is relative, that is in terms of percentage. So absolute and relative, both the values are in front of you when you conduct horizontal analysis, and that is why we call it dynamic, because you are no more confined to the data of 1 year or one company. You are going beyond that framework of data of either 1 year or one company, and that this is why we call this method to be a dynamic analysis. We call this technique to be a technique of dynamic analysis. So either you call it horizontal or you call it dynamic analysis, both stand for the similar meaning. So in horizontal analysis, I am going to show you that with an example of a company. There is a company called LK Limited, and on 31st December 2021 and 20, they are asking you to conduct a horizontal analysis of their data of two periods. So it is going to be an inter-period comparison. It is not going to be inter-firm comparison, because you are going to deal with the data of 2 years, 2020 and 2021. And we have to prepare the comparative financial statement, and it can be prepared like this. So if you look at the comparative balance sheet of this company called LK Limited, so in the first column it is asset, second column is of the year 2021, third is of year 2020. And if you look at the extreme right, we have increase or decrease in two terms. One is in absolute, that is amount, another is percentage. So say if I take example of cash under the current assets, two values are given. In 2021 the value of cash is 12,000, and in 2020 it was 23,500. So with this I would try to explain you the way we have to prepare this comparative balance sheet. So I am starting with the balance sheet. Eventually I shall tell you about the comparative income statement as well. So what we do here, first we have to calculate change in rupee amounts, and for that the way is very simple. You have to take the current year figure and subtract the base year figure from it to arrive at the change. The change may be positive or negative. So the rupee which amounts for 2020, it basically becomes the base year figure. Here it is 2021. So the older period is supposed to become the base, and the subsequent period is supposed to be the current year. Current year means the year for which we are conducting this analysis. So and if I have to find out the value in terms of rupee, very simple, current year value minus base year value. This is going to give us the absolute value. And when I have to take it in terms of percentage, very simple, rupee change, whatever change is there, divided by base year figure into 100. Why into 100? Because I want my answer in terms of percentage. So this is going to give me the answer in terms of percentage. So rupee change divided by base year value into 100. Now I'll show you the way we have computed it. If you look at the value of cash, in 2020 it was 23,500, and in 2021 it has become 12,000. So what we have done, 12,000 minus 23,500, the value comes in negative, that is 11,500. That is why we have shown it in bracket. Bracket means negative. Or you can say there is a decrease in cash. If it is not in bracket, it is supposed to be an increase. Now the question comes, how to calculate the percentage. I have told you the formula, very simple. 11,500 is the change divided by the base year value. Base year value for cash in 2020 was 23,500. and we have to multiply it by 100 because I need my answer in terms of percentage, and it is giving me a value of 48.9%. So this is going to be a decline in terms of cash in terms of 48.9%. So I'm not only having the absolute value but also the relative, or you can say in terms of percentage, I have the value. Likewise, we have to conduct, when I'm preparing comparative balance sheet, we have to prepare the statement for, we have to do the calculation for all the items which are listed here. And when you start doing so, you can find here that I have computed in the column of amount as well as in the column of percentage whatever increase or decrease. For instance, accounts receivable net, it has become 60,000, earlier it was 40,000, so increase is by 20,000. So in the column of amount I have written 20,000, and whatever is percentage I have to calculate 20,000 divided by the base value, that is 40,000. So if you calculate if you try to find out the ratio between the change and the base value, it comes to be 50%. So likewise we have to do the calculation for each and every item given in the balance sheet. So it is this simple. You can now understand the way we have to prepare the comparative balance sheet. So simply speaking, we are adding 2 more columns to our vertical balance sheet. We are provided with the figures of 2 years, and we are reporting the increase or decrease in terms of amount as well as in terms of percentage. Now the same process we shall follow for comparative income statement. Like for the same company LK Limited, we have sales, we have cost of goods sold, we have gross margin, we have operating expenses. Again we have created 2 more columns, amount and percentage, and we shall follow the same process. The difference amount we shall write, and then change divided by base year value into 100 will give me the answer in terms of percentage. Say for instance 8.3% for the first item, that is sales, right? So if you look, sales has increased by 8.3% and your net income has actually decreased by 21.9%. Now this is where we come to the answer of your question. After doing this entire calculation, a very pertinent question comes to me. Sir, what is the point of doing this calculation? What exactly we get? And this is what I am going to explain here. What you get is here. Your sales has increased by 8.3%. So the data is indicating that in a period of 2 years, from 2020 to 2021, your sales has increased by 8.3%. But on the contrary, your net income, your effective income has declined by 21.9%. Now you have a question, sir, what is the reason for this? When my sales is increasing, my profit should also increase. So what is the reason for that? That reason you can find in this point where I have highlighted about your cost of goods sold. Your cost of goods sold have increased by 14.3%, and your operating expenses have also increased by 2.1%. So there is an increase in both, not only your cost of goods sold but also your operating expenses. Now this is something which you never get from your financial statement. Your profit and loss account or your income statement is not going to tell you that see, this is the reason for your shortfall in profit. But here, with the help of comparative financial statement, we are able to find that, see, your profit has not increased, your net income has declined due to 2 important reasons. One is your cost of goods sold have increased and your operating expenses have also increased by 14.3% and 2.1% respectively. So this is the way we have to draw inferences out of this kind of analysis. So let us prepare a comparative income statement with the information given in this question. We are provided with the data of 2 periods, 2018-19 and 19-20. Sales is given, cost of goods sold is given, gross profit, administrative expenses, selling and distribution expenses, and then you have operating profit. And you have to prepare comparative income statement. So as I told you previously, we have to prepare it like this. Net sales for the 2 periods we have to write. So we have to simply add 2 columns to this question, absolute and percentage. The difference between the 2 values I am showing you here. Your sales is given for 18-19 1823, and for 2019-20 it is given to be 2910. So difference is here 1087 and you are doing the calculation. So it is 60% is the percentage change. So this is the way we have to prepare the comparative statement. Now I shall be concluding with the advantages of this comparative financial statement. Basically it helps us in finding the changes in components, and by simply having a glance at this comparative statement we can find that where is the change, what is the change in terms of value and in terms of percentage. They are also helpful in identifying the trend of changes in sales and gross profit and net profit. You can identify the trend of changes in your sales as well as gross and net profit, and of course inter-firm comparison is possible. So with this I am ending to this analysis called horizontal analysis, where we have discussed about the comparative financial statement. In the next lecture I shall further proceed with the other techniques. I hope you must have understood and enjoyed today's lecture of mine. Thank you so much.